Hello and welcome to another episode of Trust Issues. Today I'm sitting down with Randall Sandstrom, Chief Executive and CIO of Sequoia Investment Management, advisor to the Sequoia Economic Infrastructure Income Fund. We're going to talk about the fund and the opportunities for investors in the infrastructure debt sector. Randall, many thanks for joining us today.
Oh, thank you, Joe. It's a pleasure to be with you this morning, and thank you very much for inviting me on to the show.
So, could you start off by explaining what private debt is?
Yes, absolutely. So private debt or private credit, as it's often called, first of all, it's a really meaningful market. It finished last year at about $2 trillion in size, $2 trillion equivalent. And to put that number in perspective, the U.S. high-yield bond market is about $1 trillion in size, and the broadly syndicated loan market in the U.S. is about 1.4 trillion. So private credit's a big market, and there are a couple different definitions. There's a narrow definition, and I think a broader and probably better definition. But the narrow view would be, for example, a private equity firm which makes a direct loan to a medium-sized company, what's called a mid-market company, a borrower, at a high interest rate. In today's market, for example, 11 to 12%. And the key in that definition is that the loan is from a private equity firm as opposed to being by a bank or being arranged by a bank. And then I think a better and a slightly bigger picture definition would be a debt product, i.e. a loan, which is not provided by a bank and also not actively traded. And this definition really came about back in 2008/2009 when banks really started pulling back on lending because of the 2008-2009 financial crisis. And since that time, the private credit market has really taken off. It's up by a factor of about 10 times since 2008-2009. So if you were to summarize that, really, the key factors here are loans that are made by non-banks, such as funds like our fund, SEQI. There's no arranging or syndicating bank, and the loans also are not actively traded. So really, this definition would exclude things like corporate bonds and broadly syndicated loans, or some people will call those leveraged loans.
And what does SEQI offer retail investors in terms of portfolio allocation?
Starting sort of at the big picture, what SEQI really offers is an opportunity for investors to gain exposure and to gain the benefits of this private credit market. And the sorts of loans that we make, these are high yielding infrastructure credit loans to global infrastructure projects around the world. Currently, in today's environment, the range of yields that we look to earn would be sort of 8 to 11%. This is, again, in today's market. And the other thing that this sector offers investors is really low correlation to other markets. So that would be things like, stocks and traditionally actively traded bonds. That's sort of what's called inter-market correlation, the degree of correlation to other markets. But there's also another type of correlation, which is very low, and that's the intra-market correlation. So that's a correlation between one project and another. And for example, you would expect a pretty low correlation between a toll road and a hospital, for example. And what that means is that there's a huge benefit in markets such as those to diversity. And we've always run a very diverse portfolio. Currently, we have over 50 different positions in our SEQI portfolio.
And can you provide an overview of the objectives of the fund and also your investment approach in terms of the key attributes that you look for in a potential investment?
Yeah, absolutely. So it's an income fund. That's the overall objective. So paying a steady, sustainable dividend is the primary objective. But we've got a secondary objective of trying to achieve NAV growth. And the primary way to achieve that is to have excess income above and beyond the costs of the fund and the dividends that we pay out. And throughout the cycle, our total return target is 8 to 9% per annum. And when I say throughout the cycle, so that's through the business cycle. That's through also what lots of people call a credit cycle. And SEQI's got a long track record. It's been around for nearly 10 years now. And we've gone through many cycles, ups and downs in the markets, higher rates, lower rates, deflation when we started, and high inflation. And that's really a testament to the infrastructure debt sector, which tends to be pretty stable. And the reason that it's stable is that it's considered to be what's called a defensive market. And the reason it's defensive is because, it provides essential services. These are services that people and businesses need to use even in times of economic weakness. And in terms of attributes of investments, the key is core infrastructure. So that would be traditional things like transportation, power, renewables, and also what the market calls core plus. So this would include, for example, specialist shipping, floating liquefied natural gas, and the characteristics of all of these investments would be things that make it safer. So high barriers to entry. So you can't, not just anybody can come along and set up an infrastructure project. It takes a lot of money, it takes a lot of capital. So if you have a sector or a subsector with high barriers to entry, what that means is that you have lower competition, which is positive. Another attribute or another characteristic is that we want to have businesses that earn their revenue off of contracts, as opposed to selling their product just in what's called the spot market or just the open market, and subject to a lot of price volatility. So long-term contracts is another characteristic. And also, thirdly, another one is hard assets. We want our security to be against hard assets, because that's where you can usually get the best rate of recovery if you need, as the lender, to sell those assets. And that's as opposed to assets such as goodwill or services and things like that, which are considered soft assets.
Thank you very much. And could you talk us through your current sector and geographic weightings?
Yeah, absolutely. Well, our four largest sectors in order would be, first of all, digitalization. So currently our exposure there is about 23% of the portfolio. So that's a sector. So the sorts of subsectors within digitalization would be data centers. We made our first data center loan back in circa 2017. So that's been a very active subsector for us. Also, telecom towers, which are becoming more important with the advent of 5G and needing more towers. And then also broadband and fiber is another important subsector within digitalization. Our second largest sector would be really a combination of two sectors. It would be transportation in general, which includes both transport systems as well as transport vehicles. And on the system side, that's things like you would expect: ports, rail, ferries. And then on transportation vehicles, it would include things like rolling stock, and I mentioned specialist shipping such as floating liquefied natural gas as well. In terms of geography, right now our largest exposure is to North America, and that currently would include the U.S. We also have made loans geographically into Canada. That's an eligible jurisdiction for us. We don't have any current exposure there. And the U.S. has tended to be our largest single jurisdiction. And I'll talk about more of that later. But the reason for that is it's just a big market. Good solid property rights, contract law, all the sorts of things you want in a developed market. And also spreads in the US tend to be cheaper because there's just a huge need for infrastructure spending. Anybody who's been to the US, I think you've seen the state of the roads there and airports and all the rest of it. So there's a big need for capital there. There's actually more demand for infrastructure capital in the US than there is supply. So what that means is that the spreads tend to go up in order to bring that additional capital in. Following the U.S. geographically, the U.K. is our next largest jurisdiction at just less than 30%, and that's followed by Europe at 24%. the common theme within all those geographies that these are developed markets.
Great. Could you provide an overview of the performance of the trust?
Yeah, absolutely. So I think what we can do is, first of all, answer the question and tell you what the performance has been, but then we'll compare it to a benchmark or another index so we can put it in perspective. So the way that we would look at this, I think the most relevant measure of performance would be looking at total return. So that's going to be the income plus the changes in the capital value. And we will look at the total return of the NAV. So cumulatively, since we did the IPO way back in 2015, and you add all those annual total returns up, it works out to 69%. And that's through the last published accounts that we put out, which was for the 30th of September. And if you divide that by, the circa 9.5 years that the fund's been running, that works out to just about 7.2% per annum in total return for SEQI's net asset value. Now, the benchmark that we use is another fixed income benchmark, which is in sterling, so we remove any currency effects. And it's an ETF, and it represents global high-yield corporate bonds, and then, as I mentioned, hedged back to sterling. So if you look at the total cumulative return of that benchmark, and again, divided by the same time period, 9.5 years, that works out to 3.7% per annum. So that differential, the amount of our outperformance above and beyond that benchmark, works out to just about 3.5% per year. Now, the majority of that outperformance has been due to the income component of total return. I had mentioned in normal markets, private debt tends to trade about 200 to 300 basis points greater than liquid debt or liquid credit. And infrastructure debt, which is again part of the private credit market, even tends to trade at a slightly higher yield than general private credit. And some of that is due to the complexity of infrastructure. It's a market that's a creature of contracts, so it is a little bit more complex. But what that demonstrates is that we've had really solid outperformance versus our benchmark. But I think just as important as that number, as that outperformance, is that our NAV has been much less volatile than that benchmark. In fact, if you look at what people would call the beta or the asset beta, it's about half. So the volatility of our NAV has been on average about half the volatility of the underlying benchmark of credit. So that really means, we've outperformed on the total return side, and we've also had less volatility. So that makes for overall a better risk-adjusted return than our benchmark.
Great, thank you for that. So changing tack slightly, why do you think this sector lends itself well to active management, and how is SEQI differentiated from its peers?
Yeah, well, good question. And so really what we're talking about is passive management versus active management. And passive management being where you don't have an investment manager making active investment decisions. And that sort of setup really lends itself more to liquid markets where you have indices. A classic example would be a stock index that replicates the S&P 500. Some investors would be quite happy just to buy, a passive index fund and just sit on it. And one of the features of that sort of sector is that changes in the market really make up a significant part of the total return of that sort of investment. Whereas on the other hand, when you have an active investment management, that really lends itself more to, sort of illiquid markets, such as private credit. And one of the features of this market is that changes in the market really don't make up a large part of the total return of the fund. It's really changes in the individual positions that make up the significant part of the total return. So in a market like ours, which is private credit, in our case, of course, private infrastructure debt, you really need an investment manager, first of all, to find the loan. You got to find the opportunity. We call that sourcing. or the origination of the loan. And then secondly, you need to have a portfolio management function which selects the optimal loan opportunities. And then also you need to be able to monitor that loan post the investment.
And how do you manage downside risk for investors?
Yeah, well, I think the way that we do that first and foremost is really through careful asset selection right at the beginning of the process. So when we go out and we source a loan and we actually select what we feel to be an optimal investment opportunity, you got to do solid fundamental research at the very beginning. So you've got to look at all the financials, you got to look at the operations, you need to look at the team, you got to look at the management. So I'd say first and foremost, really careful asset selection. The other way to manage the downside risk is diversity. You don't want to put too many eggs in one basket. So what that means is low single name exposure. I mentioned earlier that we have over 50 loans in our portfolio. So we have really solid diversity. And it's not just diversity by name, but it's diversity by sector, by subsector, and by geography as well. And then also, things like selling underperforming assets. If something's not working out, one of the options for us is to sell it, is to either reduce the position or exit the position. And then fourthly, if something doesn't work out, then you need to be able to work out the loan, if necessary, to achieve an optimal outcome for investors. So that could mean, taking over the position and then exiting it and selling the business.
And how often do you revalue your portfolio?
Yeah, good question. So it's quite frequent. For our portfolio, our reporting cycle and valuation cycle is monthly. You'll see other funds, infrastructure equity funds, which are quarterly, um, real estate funds, which can even be less frequently. But this is something that we go through on a monthly basis. And I think one of the most important procedures in that monthly basis is the valuation of assets. And the important thing to say there is that we have a third party that values our positions. This is Price Waterhouse Coopers. They do a fantastic job. And really the process is fairly straightforward. If for some reason it is a liquid loan, and we don't have a lot of liquid positions, as we talked about earlier, we really find the best investment opportunities and the best yields in the non-public space, so in private loans. But if it happens to be a public loan, then the valuation is more straightforward. And what we and Price Waterhouse will get are marks on the position because it trades in the market from broker dealers, and then we'll take an average of those marks. The majority of the portfolio right now, you know, over about 95% are private loans. So in that case, there are no really publicly available marks because the positions don't trade that frequently. So there, what's done is what's called a discounted cash flow analysis. And this is performed by looking at the expected cash flows from the project and then discounting those cash flows back to a present value at an appropriate discount rate, which properly reflects the risk of those cash flows.
What do you see as the key growth drivers for the infrastructure sector?
Well, I think it's the drivers are pretty pronounced and quite exciting actually. I mean, governments around the world are just crying out for more infrastructure spend. The problem is money. A lot of governments, particularly post COVID, they don't have enough cash to really finance all of the infrastructure investment opportunities and needs, rather, in their markets. So there's a huge need for private capital. So I think that's a major driver of infrastructure growth going forward. Another driver right now in infrastructure are the major themes out there. Energy transition, as the economies around the world move to a lower carbon environment, there's going to be a lot of investment needed in that energy transition to a lower carbon environment. And then also digitalization. This is a major growth area. And then those are the two major themes in the market. And also, as an example, I mentioned that we have most of our exposure in the U.S. and a big driver of growth and this is really the case around the world, but it's particularly the case in the U.S. I mentioned earlier that the demand for infrastructure capital is greater than the supply, and that gap, that what's called an investment gap, is estimated to be about $3 trillion over the next 10 years. So what's interesting about the US is not only is it a big market with lots of opportunities, but because of this fundamental mismatch between the demand for capital and the supply for capital, the interest rate needs to go up. The spreads over the base interest rate needs to widen in order to attract this private capital that's needed. So strategy, our investment strategy of having exposure in the US is really to take advantage of the lending opportunities that will present themselves as this investment gap is plugged over the years to come.
And one final question for you. What's the outlook for infrastructure debt given falling interest rates?
Yeah, well, I think the outlook is good. I think one theme that you'll see is as interest rates go down and get lower, you're going to want to see more borrowers refinance. So we would expect refinancing activity to pick up with lower rates. And what's good about that is you're looking at an operational project as opposed to new construction lending. We're very cautious on new construction lending. We don't really do a lot of that. Sometimes we see good opportunities in that space, but we prefer to finance operational deals. So these refinancings that we would expect, those would be for operational projects that have a track record where you can actually see the volume and you can see the pricing and you can make an investment decision or a credit decision based on those actual numbers as opposed to forecasts. And I think also as interest rates drop, you'll see M&A activity pick up. And that's a good source of deal flow for us as, one sponsor, purchases or buys a project from another sponsor. They almost always want debt financing. They'll put up, part of that purchase in equity, and then they'll go out and try and find the debt. So as M&A activity picks up, as rates drop, we would expect to see more activity on our side in terms of deal flow financing that.
And on that note, many thanks for joining us today.
Well, thank you so much. It was an absolute pleasure to do this. Thank you for inviting me on the show, and happy to do this anytime.
Fantastic, thank you. I'd encourage you to visit SEQI's website to find out more information about the Trust, including recent articles and videos. You can also head over to the Kepler Trust Intelligence website to find our latest research note and insight articles. Thanks for listening, and we hope you join us again soon for another edition of Trust Issues.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.